Thank you all very much for coming this morning, and welcome to the IISS-US. My name is Sam Charap. I'm the Senior Fellow for Russia and Eurasia here at the IISS, and we're very pleased this morning to have with us Martin Gilman, who is currently the Director of the Center for Advanced Studies and Professor of Economics at the Higher School of Economics in Moscow. He has been there since 2006. In 2010, he published this excellent book, No Precedent, No Plan, inside Russia's 1998 default, which in large part was based on his previous experience in various roles dealing with Russia at the IMF, including as Assistant Director in the IMF's Policy Department, where he was responsible for sovereign debt issues, and as the IMF's representative to the Paris Club. He was also the head of the IMF's Moscow office from 1996 until 1999? 2002. So with that, I will hand it over to Martin. We are on the record this morning, and after Martin's presentation, we'll open it up to Q&A. Thanks again. Start talking.
Okay, thank you very much, Sam, and I'm pleased to be here in Washington. My presentation today, I'll go through a number of slides and walk you through the data. It's going to be rather data intensive. I hope you don't mind. My idea is to talk about the Russian economy in perhaps a way which is a little bit unusual within the Beltway and probably within the MKD as well, which is to try, if we can, to stick to the facts. Andre, I'm glad you're here this morning because I know you like to stick to the facts. The reason I called it demythification is because I think there are certain myths about the Russian economy that, like any good cliche, probably has some element of truth to it. Where there's fire, where there's smoke, there's usually some fire. But I'd like to see if we can come up with it, looking at the facts, we can come up with perhaps a more nuanced view of the reality based on macroeconomic data. And I think that like many cliches about countries' economies, Russia's no different. They have a long pedigree and they're pretty hard to change. I think many would perceive of a cliche, for instance, about the hardworking Germans, or the spendthrift Italians, or the tax-dodging Greeks, or the thrifty Scots. And that's just within the EU, which is rather topical. But I think Russia is in many ways no different, and whether you're an outside observer or living within the Boulevard Ring, there are certain perceptions or cliches about the Russian economy, which could be characterized as greed, corrupt, devious, conspiratorial, etc. So what I'd like to do, as I said, is to go through a few slides to consider these myths individually, and I'll start with perhaps one of the easiest ones, I think, in terms of trying to rebalance the score. So let's see what it is. Okay. So the question is, what do the facts about the Russian economy really tell us? And myth number one would be the obvious one that you see bantered about quite often: should Russia even be considered a BRIC? Well, what do the data tell us? We all know that if you want to look at BRICs by size, well, I guess there's, in my view, not much content that Russia formally would be a BRIC. It's the largest landmass in the world. It's according to the IMF data for 2012, it's the fourth largest economy in terms of nominal dollar GDP in the world. It's the ninth largest in terms of population. It's of the BRIC countries, it's the third largest based on the IMF data, both in terms of nominal and purchasing power GDP for 2012 with the IMF data, with China and Brazil slightly ahead of it and India just behind it. So in terms of size, Russia clearly would be there. But what about growth dynamics? That's where people really have serious concerns about whether Russia should be in this group that Goldman Sachs, this acronym that Goldman Sachs put together. So I would start with chart 1. I highlighted Russia in the yellow, and wish we had a bigger screen, but we don't. Anyway, so I hope you can see on the bottom line, this is a cross-section of 40 emerging market economies, the main emerging market economies, and my former colleague at the IMF and friend, Jonathan Anderson, based in Beijing, maintains this data set based on mostly IMF data with supplemented by Haber and other statistics. So that what you'll see is that chart 1 is just average real GDP growth over the 12 years, averaged together, 2000 to 2012, and you'll see that Russia certainly comes above the emerging market average in terms of average GDP growth, nominal GDP growth during the period. Certainly above below China and India, but well above Brazil, which is about eighth one from the end there. But okay, but you could say, okay, but that's in terms of nominal, of real GDP growth. What about if you look at it in terms of per capita growth? Well, the story on per capita growth, real GDP per capita growth, Russia is even stronger because the demographics have not been very positive for Russia during that decade. And so that Russia, in fact, jumps to position number 4, so just slightly ahead of India in terms of per capita of real GDP during that period. And if you look at it in terms of average US dollar GDP growth, not real, but nominal dollar GDP growth, in fact, Russia is the second fastest growing economy in terms of dollar GDP on average during that 12-year period, just behind Kazakhstan. So that's a kind of a surprising, just factual result. And it means that by that aggregate, very aggregate measure, and with all the problems that one could point out about taking an average over a 12-year period, it certainly looks that Russia would be considered one of the more dynamic economies in the world. So on that basis, both in terms of size and economic dynamism, I would say that yes, probably Russia should be considered in the BRIC countries just as much as Brazil or India. Okay, but so what? Okay, so it meets some formal criteria for size and dynamics, but we all know that Russia is just an oil story. Okay, I mean, without oil, Russia wouldn't be anywhere near that league. The whole economy is driven by oil. At least that's the perception. And the idea is if you took away the oil, what would the non-oil sector is stagnant. It would not be able to deliver growth to the real economy. You know, what do the facts again say about the role of oil as a driver of GDP? Well, I've always been one of those, ever since my IMF days, who fondly believes that one should compare apples and oranges with oranges and not apples with oranges. So I don't like to mix nominal and real GDP. One of the problems about oil prices is that they don't directly drive real GDP. So let's look at this graph. I don't know if you're really going to be able to read it. That's the problem, unless you have extremely good eyesight. But what it shows is, this is a bar graph, including 2013 estimates, and the yellow is, these are real drivers of GDP in terms of percentage contribution, positive or below the line negative contribution to GDP each year. Real, okay? This is your your old Keynesian formula. Change in Y equals change in C plus change in I plus change in G plus change in net exports. Okay, so the yellow is consumption. Okay, and the bar here, actually should have probably changed the colors a little bit, is investment inventories, and the green is net exports. In other words, volume increase in exports minus volume increase in imports. Now you can see here that what really drives Russian GDP all through this period, except for 1999 and 2009, is what? Consumption. Investment also usually making a positive contribution, and inventory. The only years in which you had a positive contribution of net exports to GDP, real GDP growth in Russia, was in 2009 during the international financial crisis, and very slightly in 2002, 2003. And when people are thinking of oil-driven economy, they kind of, at first blush, think they would see it showing up in net exports. But not at all, remember, because these are real. Okay, this is not a reflection of oil price. So, you say, fine, but we know that what's really going on in Russia is not it's not Nigeria, it's not Venezuela, it's not Indonesia. The oil sector is not dominant. The oil sector is not a dominant part of the economy in terms of employment and investment. So it's not the oil money directly coming into the economy, it's going through the government. Okay, the government basically gets the oil money and then spends it. So you're not going to see the driver of GDP in net exports, which you obviously don't. If you were to really go into the details of the consumption and investment numbers, you would see that it's really driven by government. That would be the presumption, okay, that for Russia to be a real oil story. But again, sticking to macro data, if you go to government spending in real terms, what you find is that with the exception of just before the last elections, before the 2012 Duma and presidential elections, that with the exception of the burst in real spending in late 2011 and beginning of 2012, in fact, you do not see in recent years after the coordinated London agreement for all governments in the G20 to massively intervene against the financial contagion in 2008, 2009, you actually see that Russian spending, despite higher oil prices, has not been going up very much. In fact, what I wanted to point out is that Russian fiscal policy has been surprisingly counter-cyclical. Generally, the budget was in surplus. The yellow line is revenues. So the difference between revenue and expenditure is a budget surplus. So you would think that if they're spending or a lot of the oil money, you would get it reflected in the change in spending, which was the previous graph, or you would show it as a massive increase in government deficit, falling revenue and increasing expenditure. But what you've really got is more or less a balanced budget. Okay, so you have to hesitate and say, well, you know, okay, maybe there's more to it than we thought. So, well, what about looking at some indirect evidence of Russia as an oil-dependent economy? And, you know, I guess the question to my mind is there a sense in which the non-oil private sector, particularly manufacturing, is being squeezed out? You know, kind of Dutch disease, significant real appreciation of the ruble, and what you would expect to see in a commodity-dominated economy. And I thought it was very interesting when, again, probably the detail is too hard to see. This is basically a chart in percentages, negative and positive, of export growth in US dollar terms, year-on-year, 3-month moving averages. And the yellow line are the 40 European emerging market countries that I showed in the original bar graphs. Those 40 countries, average growth of their exports, total exports of the emerging market countries in yellow. And if you plot against what you might say the control group, using the total 40 emerging market economies, if you plot what their performance was against Russian non-fuel, which is the blue line, you'll find, in fact, that Russian non-fuel export changes year to year were more or less in line with what was happening in the rest of the emerging market control group. And more recently, I guess since about 2006, we've been able to have a specific number on Russian machinery and manufacturing, and it follows pretty much the same. And this is telling us, I think, that perhaps the non-oil or manufacturing sector in Russia is not performing any worse than the counterparts in other emerging market economies. Now, the caveat there is, of course, that if you look at other emerging market economies coming into 2013, nobody's exactly thriving. If you've looked at, if you've looked at East Asia, if you've been looking at Brazil, it's a difficult environment for everybody trying to export more, and that includes Russia in terms of its non-oil exports as well. But it's in good company, you might say. It's important to, I think, to keep that in mind, because, let's go to the next one, where what I wanted to show here is that, okay, if non-oil fuel exports, though, are only 12%, the equivalent of 12% of GDP in the Russian economy, non-fuel exports. So it's only part of the story of what's happening in the whole economy. And oil and gas, the last 12 months account for, say in 2012, account for about 17% of GDP, oil and gas exports, as opposed to 12% for the for non-fuel exports. So if we were to look at this, I thought this graph would be interesting if we're trying to get a sense of, is Russia really being dominated by the oil sector, government spending, government investment? And this was a way of breaking down GDP at constant prices over the same time period, but by sector. And what you see is the dramatic rise in the other services, private services, transportation, consulting, banking, insurance, education. And in constant percentages of GDP, the rest, property constructions come up a little bit, but public services and primary sector have been basically constant shares of GDP over this whole period. So you don't see the primary sector. If you were thinking, well, that oil, gas, and commodities are driving Russian GDP growth, you would expect to see a rising percentage of the, as a share of GDP, its contribution of the primary sector, which you don't. So I hope that I've maybe made people think twice about that. And just to finish the point, that I looked at the Russian automobile production and sales. This is an index based on 2007, and you can see that even domestic automobile production, which was caught up in that number earlier on manufacturing, so it was already, but just as a specific example, that auto sales and particularly auto production have more than recovered from the pre-crisis peak. And no doubt with the help of foreign direct investment, but you've had a significant recovery, although in the last couple of years it's, once again, like elsewhere in the world, seems to be flattening out. But I guess the point is that despite Russia's, at least in my view, despite Russia's well-deserved reputation for being a very hard place to conduct business, that if you believe the data, which I guess I do, that the non-oil economy has somehow managed to succeed at least as well generally as their emerging market comparators. So that leads me to the third point. And I couldn't resist putting this cartoon in there. It's just, I love it. But you won't be able to read it. Says, sorry, comrade director, I put the, when I was cleaning, I put the, I turned the chart upside down. So, the myth number 3, or this cliche, is that Russia has a stagnant economy and it's only going to get worse. And I think it's a fairly prevalent theme. And for all I know, maybe people saying that are right, that it will only get worse, but I'll come to that when I get to the conclusion. But as we saw in charts 7 and 9, the one on the automobile production and the one on total exports, Russia really did suffer a setback at the outset of the financial crisis, starting in the last quarter of 2008, beginning of 2009. And I think that many have interpreted that as, okay, Russia had, for various reasons, a good run until then, but now it's all over. Okay, and Russia's going to be in pretty stringent circumstances and in decline, because all the productivity gains that they were able to manage from the Soviet era capital stock have been used, and without productive new private investment, it's nothing is going to happen in the economy. So, the question is now, well, what do the data show? Again, I turn to automobiles as an example. We're just there, but I want to show you against the emerging market comparators. Again, the yellow is the total 40 countries in the emerging market sample of automobile sales, with 2005 being indexed to 100. And what you'll see is that, just for comparison purposes, this is total emerging market. So Russia's not doing as well as the total emerging market. Russia is the blue line, but then of course the rest of the emerging market, the average of the 40 countries didn't suffer nearly as severely as Russia in 2009, which is a whole other subject we could go into, why Russia was hit so much more severely. But you'll see that I've also plotted what I call East European crisis countries. Now this is Bulgaria, Ukraine, Balkans, Baltics, yeah, and Hungary, sorry. And they plummeted not quite as far as Russia, but have pretty well stagnated in terms of their automobile sales since the depths of the crisis, where Russia has, as I pointed out in the earlier graph, has more than rebounded. So again, if you expected that Russia, like the rest of Eastern Europe, dropped after the financial crisis and has stayed stuck on the floor, well, not according to automobile sales. And what about private sector credit? Again, this is going to be a little bit harder for you to read, I think. But what we see 4 years after the crisis, again, this is emerging market averages of private sector credit growth. These are the East European crisis countries. Basically, private sector credit has been just barely positive. In Russia, it's rebounded. And if you take the subgroup of Europe, emerging market fuel exporters, of which Russia is a member, like Indonesia, Venezuela, Nigeria, you'll also see that they have rebounded. So again, Russia is not in the camp of the East European crisis countries after the crisis. It's even doing, in terms of private sector credit, now whether you think that's a good thing or not, whether it leads to a bubble is, again, another issue. But Russia's private sector credit has rebounded even above normal, the normal averages of the group of emerging market economies. We do know, of course, that in this post-crisis world, as I was alluding to earlier about the difficulty of exports of the emerging market group and of Russia in particular, that growth is slowing down in Russia. It was recorded at 3.4% last year, and according to the IMF WEO update of January, they're projecting 3.7%, although I saw the IMF representative in Moscow yesterday talk about 3.8, but it's a nuance, which is still better than Brazil, but you can see that the Russian output and industrial growth has been slowing down. I think the Russians are even more pessimistic than the IMF is about their prospects this year, although that's a typical tactic of the finance ministry to talk down growth estimates to keep their colleagues in the government in line from trying to spend too much. So I guess what I say here is that Russia's GDP, like everybody else's, is going to be less buoyant, but Russia doesn't have the problems of a significant debt overhang, and with growth, with savings still at almost 30% of GDP, it should be able to maintain growth at least in line with emerging market averages over the medium term, barring what I will say in conclusion. Okay, so that leads us to the last point, and then Sam will get mad if I keep going on. So myth number 4 is that, which is really almost a continuation or a nuance of the previous one, is that time is running out as Russia has entered a self-induced economic spiral. Some will say it coincided with the re-election of Putin, of low investment in massive capital flight. Who would want to invest in Russia if Russians are not going to invest in Russia? Okay, money just flows out of the country. So, again, what do the data actually show us? Well, let's start with the obvious point that Russia is obviously unlike the other emerging market countries. These are 20 countries on average. they run a current account deficit. All right? Okay, China is not typical. But on average, most of the, if you take Turkey, if you take India, if you take Brazil, if you take Poland, etc., they run current account deficits. Russia runs a current account surplus. It was at 10%, now it's closer, well, probably a little below 6% now. And it runs a trade surplus of almost 12% of GDP. Okay? So it means that absolutely correct that Russia's, you can't analyze Russia without paying very due respect to oil and gas earnings. Makes a huge difference. It separates Russia really from most of the other emerging market comparatives. And it puts Russia really very much in the same camp as other fuel exporters, like the major Middle Eastern exporters, Nigeria, Venezuela. Okay, and so it makes Russia unique among the BRICS because it's the only one that has a pattern like this. The good thing for Russia, though, that comes from this is, yes, they're hugely dependent on oil and gas earnings for this huge current account surplus, but they have buffers that I mentioned in terms of balanced budget, extremely low public debt, and they've had 4 years since the crisis for corporates and banks to delever. Okay, so they're in relatively good financial position going forward. And so the question then is going to be, if I were you, I would ask, well, that's the balance of payments. But we all know that in Russia, the real story is the budget. It's can the government spend the money? And in the balance of payments, oil would have to drop and probably stay at about $65 to $75 a barrel for a while for the current account surplus to be eliminated. Just to be eliminated, not go into deficit, but to just be eliminated. The oil price would have to go and stay at 75. It would have to even go lower for Russia to get into the kind of balance of payments difficulty of an Argentina or a Ukraine. The price would probably have to go to, I think our back of the envelope calculations would probably be in the $30 range and stay there for a while for Russia to have a real balance of payments problem. So let's turn to the budget, because that everybody says, well, look, even at current oil prices, say $110 a barrel for Urals, the budget is barely in balance. Okay, so obviously the budget is going to be very critically dependent on changes in oil price, and if oil prices go to $90 or below that, then the budget is going to be in big trouble. And the fact is that it could, depending on how they play it, but first of all, I start with the point that unlike 3/4 of the emerging market universe, the good news is that the Russian balance budget is in balance. So at least their starting position is a rather healthy one. They also have the stabilization funds, etc. But so the starting position for Russia, having a balanced budget as opposed to a budget deficit, if you're going to deal with a drop in oil prices, is probably not a bad thing. The other thing, besides having a budget which is in balance as a starting point, is that Russia's public debt ratio is one of the lowest in the world, just behind Estonia, Saudi Arabia, and Chile. Okay, so that effectively there's no sovereign, we're not talking about Eurozone peripherals. There's effectively no sovereign debt to worry about. There's no risk of a repeat of a 1998 default by the sovereign in Russia. So that low debt, balanced budget, and then of course the importance of a flexible exchange rate policy. The importance of a flexible exchange rate policy is critical because it means that the budget balances right now, let's say, at $110 a barrel, okay? But if oil price drops and the central bank lets the ruble, instead of intervening to support the ruble, let the ruble adjust as the oil market price declines, then the budget will still be receiving maybe the same number of rubles, okay? And that's really important, okay? Because the expenditure in the budget is mostly rubles. There's very little foreign denominated expenditure in the Russian budget, okay? So that as the price drops and the exchange rate adjusts, then the budget could, depending on how much they allow the rate to adjust, could be receiving more or less the same number of rubles. Now, let me come to a scenario where, let's say, the oil price crashes. What happens to capital flows? Because that's the other instance. Okay, we say the budget may have some cushions or mattresses there, but what happens with capital flows? Isn't that really the Achilles heel? Money is hemorrhaging out of the country. Well, if you look at this chart, these are the, excluding the emerging market fuel exporters, this is the average of the capital account for the other 35 emerging market non-fuel exporters. Small surpluses, small deficits, reflecting basically their current account positions. Now look at Russia in the blue line. Okay, Russia has usually huge capital outflows. Actually, as I say here, averaging about 4% of GDP going out of the country. And you see articles in mainstream newspapers talking about Russian capital flight. Okay, well there it is. But I'd like you to look at another chart if I compare Russia to the emerging market fuel exporters. If you look at the emerging market fuel exporters, you'll see that Russia actually is in pretty good company. That the net non-FDI capital flows as a percent of GDP, the yellow line, the EM fuel exporters, and Russia is basically right in line. In fact, if anything, Russia's average position is actually less negative than it would be for the capital outflows of the other EM fuel exporters. And say, well, do they all have a business climate problem? I mean, are they all countries in which no one wants to invest and people are trying to get their money out because there's a terrible investment climate? And it could be. I mean, it could be. I mean, that's the maybe in Russia's case, it really is, the capital flight is driven by just a very bad investment climate. But it could also be, and once again, there's probably too much text here, that you could put it the other way around and say that what's happening is not that there's too much capital flowing out. These countries are saving too much money, or there's huge savings. Remember, I was referring to earlier that Russia has a savings rate of almost 30% of GDP. Well, it actually has a capital investment rate of close to 22, 23% of GDP. Okay? And the difference is the capital outflow. Do you want that extra 7% of GDP to be invested in Russia? Not necessarily. It depends on the marginal efficiency of capital and where investment returns are better. So what we find is that average savings rate of the fuel exporting EMs is about 44%. And so with such high savings, it's hardly surprising that money flows out of these high saving countries to where it can be productively invested. Now the question is, well, does Russia get any of it? Maybe, you know, all the money is flowing out of Russia. And I think that the next graph, and maybe I should conclude soon, is fairly telling. This is a chart on gross capital formation on average 2000 to 2012, which shows that in terms of gross capital formation of all the sample of 40 countries, that Russia is, in terms of, there are a few at the extreme, China, Vietnam, Indonesia, that had extremely high rates of gross capital formation. But Russia's pretty much in the middle of the pack at about 22%. Now that would not be an indication that Russia lacks investment compared to the emerging market control group. If Russia were really a capital flight country, you would expect Russia to be below Nigeria, right? But no, I mean, Russia's doing pretty much what the others are doing, and actually has a gross capital formation above that of, say, Saudi Arabia. Certainly above that of Brazil, but we all know that that's Brazil's Achilles heel. It's not enough investment. But the point here is that it may not be so much the local investment climate that we all harp on as the problem in Russia. It's just the fact that Russia shouldn't really be compared so much to other emerging markets as a control group, but to other emerging markets that are fuel exporters. So I reached my conclusion, finally, which is simply that I thank you for your patience in going through all of this data very quickly. The point being that I think that there is something to these myths, but I think that it's useful to try to see what facts also show us. And that if you just look at the data, that the macro balances, looking back from where we are now, not going forward, but from where we are now, the facts show us that Russia actually has one of the healthiest economies in macro terms on the planet in the last decade or so. As I said, it's foreign exchange reserves, third highest in the world. It has low debt. Growth is slowing, but it's still okay, and that the budget is in balance. In my mind, the real problem has been that Russia could be doing so much better than it's been if it were properly managed. And here, I think, in my humble view, the problem is politics. But that's a whole nother subject. And so I think I'll leave it at there. Thanks, Sam.
Thank you very much. So, we'll open it up for questions and comments now. I'd ask you to identify yourself before you make your remark or ask your question. And we'll start with
I'm Carly Balser, Georgetown University. Thank you. It is really important to get away from some of the basket case headlines that we see in the papers. On the other hand, you've been emphasizing consumption. I'd like to ask you to talk a little more about the auto industry. Auto sales and auto industry aren't the same thing. Those sales are overwhelmingly foreign assembly plants in Russia. The good news in the auto industry is that outside of Kaluga, they're actually making about a third of the parts that are going into those foreign cars in Russia, which is unexpected, including for the Western companies that went in, and they never thought they would get the local content. Even Geely, the Chinese company, is opening an assembly plant. On the other hand, there are no auto producers left in Russia to take advantage of the parts. I don't think any of the Russian companies are making more than 10 or 20,000 passenger vehicles a year anymore. So I'd ask you to kind of give us a sense of where the bright spots are in the economy outside of the energy sector and consumption.
So let's take a couple.
Okay, sure.
Over there.
Yes, hi. I'm Mindy Reiser. I'm a sociologist, and I've worked in Central Asia and the Caucasus. I wonder if you have any figures on income distribution and rural-urban differences. You give us a figure about consumption, but my question is, who is consuming? Who is doing the bulk of the consuming? And I think that could shed some interesting light on some of these questions you've raised.
One more.
Will Schwartz, RAND. I want to thank you for your remarks. I was one of the co-authors, not the economist on the team, of a RAND study that came out 3 or 4 years ago, which had very similar conclusions positively. Keith Crane's excellent economist who worked with it. And I was one of the people who went and briefed it around. And no one ever wanted to talk about the military stuff or the acquisition or around their foreign policy. They were always focused on the economy and how could RAND say that there was a positive economic story with Russia, because that countered everything that was amiss. So I sort of thank you. My question is, how do you think WTO membership will impact overall the Russian economy and its trajectory?
So let's start with those three.
Okay, thank you very much for the questions. And let me say at the outset that I'm a macroeconomist. So once I get into sectoral issues, I don't claim any particular expertise. And I'm sure there are better experts at some of these issues in the room than I am. On the automobile sector, I obviously concur with the fact there is effectively no domestically owned automobile sector in Russia. And frankly, I don't care. I mean, it's fine. Doesn't make any difference who owns it. There's not a domestically owned automobile sector in Sweden anymore or in Britain, as far as I know. And as long as foreign manufacturers bring the know-how and technology and use local inputs and develop the labor force to produce automobiles, and they're taking the risk for it, I think it's a very healthy development. You may remember I had a table, a chart earlier that did have domestic automobile production here, as well as sales. I quite agree with you that sales are not the same thing. Sales can be just driven by point of sale, easy credit to consumers, but the production has been going up, and it doesn't look like automobile inventories have been, that they've been piling them up, so they're continuing to sell. But in recent, I mean, if you were looking at the data in like the most recent months, there are some signs that things are falling off, as they are elsewhere in the region, not just in Russia. So the automobile sector is one which I think continues to be promising, because Russia is, as you all know, is one of those countries where, unlike in advanced economies, there is still a significant market for first-time buyers, people who've never had cars in their lives and want to trade up to have an automobile, just as we find in China. So I guess it's this year, I guess it's 2013, where Russia is slated to become the largest car market in Europe, overtaking Germany for the first time. And so all the car manufacturers are certainly very interested in the market. You asked about other sectors, and I'll be perfectly honest, I always try to avoid that question, where are the bright spots? Because whatever I say, I'm sure it's going to turn out to be wrong. Otherwise, I'd be a smart stock picker or something, I guess. But I certainly think that the areas where we're likely to see further progress is the share of the service sector in share of GDP, because I think it would be a fairly natural development that the Russian service sector, which, remember, after the collapse of the Soviet Union, or after in the Soviet times, was minimal. I mean, it was really minimal. That it should eventually converge towards kind of Western standards of services in the overall economy. As we know, in Western Europe and the United States, North America, the service sector is anywhere from 60 to 75% of total economic activity, sometimes even more, and that there's no reason to think that in Russia it would be any different. because there's huge demand for services of all kinds. What exactly they would be, I'm not sure. But one example I would give is that Russia is still a very underbanked economy. Most Russians still don't have bank accounts, much less debit or credit cards, and that it's very ripe for expansion. Consumer debt is very low, and I would expect that consumer finance and financial services of various kinds will be, again, an area that will be developing rapidly over the next few years. Just to, not to prolong this point, but ever since my IMF days when I started working on Russia 20 years ago, 1993, one of the observations that always stood out for me is the low demand for ruble money in Russia. Yeah. If you take M2 to GDP ratio, I mean, Russians didn't want to hold rubles. They didn't want rubles. They, anything, dollars, euros, gold, whatever, but not rubles. They just kept a little bit of transaction demand for rubles. And I guess that's how you explain the Cyprus phenomenon. I mean, you don't trust your own domestic banking system or your own currency. You do it offshore. At least one of the motives. But I've always been fascinated at the low demand for ruble money. And I've always said that I will believe that the Russian economy has really turned the corner when I see ruble demand for money rising to at least the levels that you find in Eastern Europe, say in Poland, more in the 65 to 70% of GDP, not the 105% in Germany or something. But in Russia, demand for money is still, based on the latest numbers, no more than about 35% of GDP. So it certainly still indicates to me that the Russians have not come to terms with their own faith in their own economy. So it's not just foreigners who are skeptical, it's Russians. Probably, as my wife, who's Russian, always says to me, it's much easier to convince me than skeptical Russians about what the prospects for the economy are. And so I would just, again, long way of answering your short question, that I think that the service sector is probably where we will find growth in the future, and I would look to Western economies as an example of the kinds of sectors that those are likely to be. On the other question about income distribution, if you look at Gini coefficients, in terms of overall inequality, it's interesting that the numbers that my colleagues at the Higher School of Economics put out, or the World Bank, for instance, that Russia is still more egalitarian than, say, Brazil. That's not hard to do, but is say behind the United States and certainly well behind Western Europe, and it seems to have worsened a little bit in the last few years, although this data often tends to be lag behind, because I haven't seen 2012 data yet on the Gini coefficient. And we all know that it's a huge problem, particularly with the urban-rural disparities in Russia. And that's where you get government officials exasperated that they can't get more resources into the regions to get people to stay in the regions. You see this new Far East initiative that Minfin is against, just pouring money, as you've traditionally had this problem of trying to pour money into what were so-called the Northern Territories. Rural exodus is a kind of a fact of life in many countries. We see it in rural France, and we see it in Russia. I don't know what's going to stop it, because it's hard to imagine what's going to reverse the flow of where the income is going to come from in the rural areas. I think that, like many countries, Russia will just see increasing urbanization because that's where the money is. I guess that's an unfortunate thing, particularly with a country that has more than 17 million square kilometers of landmass, almost twice the size of Canada. So it's rather unfortunate, but hopefully sociologists will figure out some answer. On the question of WTO membership, it can't be a bad thing. It's got to, even if the Russian government are pretty half-hearted about and always were, in terms of their membership, it's got to be a good thing that the largest economy that was still outside the WTO is inside, and at least has access to the mechanisms for trade disputes and arbitration within the WTO rather than outside of it. Is it going to make a big difference in Russia? I don't think so. I don't think it really makes very much of a difference. But it's one other factor. It's like eventual membership of the OECD or their associationship with the OECD, that the more the Russians are involved with the outside world and they consider it important for themselves, probably at the margin the better it is. But I think I've been too jaded by my own experience in dealing with Russia from the IMF that outsiders can make very much of a difference.
What about the impact on competitiveness domestically in terms of the potential opening up that WTO over time once the transition period ends apply?
Well, Sam, again, I'd have to go back and look at some of the specific numbers, but as I remember looking at it even during, because I remember I wrote something early on when in the days when Russia was, its membership was still pending, that Russia is an extremely globalized economy. I mean, Russia is not China when China was opening up to the WTO. Russia is already a very open economy, both in terms of trade and capital account. It's the only major emerging market country in the world that has a completely convertible currency. Since 2006, there are no capital controls in Russia, which is why in 2008, when the crisis hit, it's not like in Nigeria or Indonesia that money just came out of the banking system. People had to run on the banks. They took the money out of the country. You couldn't do that in Brazil or India. Okay, so and the same thing with the trade account. It may be that the balance of payments, because of the size of the Russian domestic economy, it's not a huge open economy like a Switzerland or a Belgium, but for a large economy, it's extremely open and very dependent on imports, as we know. I mean, you go around anywhere in major urban areas, and even much of the agricultural produce is brought in from abroad. So Russia is both, it's not like Japan or India protecting small agriculture. It's fairly open across the board. There are some particular issues in certain industrial areas around avionics and such that I'm aware of, but I don't know, even at the transition period, how much of a real difference it will make. But I will admit that I'm not a WTO expert on that.
Okay, let's take three more here. You're next, Andre. Right here.
Thank you. My name is Gloria Ospina. I am a political scientist, a veteran political economist. And I have two questions. One is a little bit of a curious question about a remark that you made in answering one of your questions, which is that there are not a lot of banks in Russia, and the people don't have credit cards. And so the question would be, how do normal individuals, like you and me, you are there, how do you handle, your money business, your transactions? I mean, that was a surprising thing for me. Now, the second one is more on a political economic kind of thing. You said that you are a macroeconomist, okay? And I am a political scientist or political economist that happens to see that politics and economics both theoretically and practically are always intertwined. I know that you're doing this, but I will be doing that because I have been doing developing economics for a while. So my question will be, by the end of your presentation, you said that some people may think that Russia is doing good, but it's not doing as good as it should because of politics. But on the other hand, my question would be to you, what does explain, despite all the history of cultural difficulties and all kind of things in the older Russia, what does explain in the current Russia the healthy of its economy?
Explain the health.
Yeah. Why is such a healthy emerging economy?
Okay.
Okay.
Andre?
I have a comment and question.
Okay. You want to introduce yourself first for the rest of
Andre
the
Lario on Gate Institute at the moment. Can I use this chart to demonstrate my comments, Martin?
Sure, sure.
Martin, I have a problem with this yellow graph that you put here. Because from the title, it suggests that index is year 2007 equals 100%, right? So if it is for both of those lines, they should coincide in the area of year 2007, which is not. So for this blue line, it is about 100%, but for yellow, it's definitely not.
Yeah.
So that is why if you have it in the same scale, it should coincide or some kind of be close to each other in the area of year 2007, which is not.
Okay.
So just it looks like it is shifted substantially downward, the yellow line. So, and if it would be put on the same scale, so this yellow part about year 2000 should be some way here, and that is why this old yellow line should be some way here, much higher. So that is why it could be maybe in some parts it go in parallel, but certainly the sales would be much higher than
Okay,
the production. The first one. Second, I'm a little bit worried about this spread, because if it is production and if it is sales, it means this is a difference, means export.
Mm-hmm.
It means export of automobiles from Russia, which is not the case, definitely in year 2006. It's vice versa. So that is why there is a problem with the yellow line, which we need to look at. The other one is this part, because it's a year 2009, and I don't have it handy with me, these data for automobile production, but we had a very low point was in January 2009. After that, output started to grow. Here it's quite clear that the lowest point was after this low. It was still a continuation and some kind of at the end of year 2009, which is definitely not the case. Something wrong with this part of the graph. But my question is about different. If you can speculate about part of this graph, which seems to me quite correct. I mean, this part. It's automobile production, but if we look at industrial production or manufacturing production or GDP, it will be roughly similar. It's not completely, but roughly similar. And here we can see two different crises. Not even two different stages of crisis, but two different crises. And this is probably for economists, is the most interesting topic for thinking. The first crisis, or some kind of recession, would be more accurately. First recession was roughly from January year 2009 until August year 2008, until roughly August year 2008. And here we have a slightly slow recession, not substantial, no deep, even with some peak of activities in July and August year 2008. It's more or less similar for many indicators, not only for automobile production. And after that, steep decline, actually some kind of falling everything from August year 2008 until January year 2009. So the question is, I would like to ask you to speculate, what are the reasons for this particular crisis and for this? Actually, this may be not so interesting because it's some kind of universal global crisis, which Russia is not very different from many other economies. It just, we can claim. United States it's so, but it's interesting. It started in August, not in September, because in the United States, Lehman Brothers started on September 16th. And fall in production in Russia started in August. So it's a couple months or months and a half before U.S. crisis. So that is why we cannot claim that U.S. crisis caused even this second beginning, at least. So maybe it's aggravated but not studied. But this crisis cannot be explained by U.S. crisis at all because it started in January year 2008. It was not so deep decline as it was. It was some kind of slow coming into recession. Nevertheless, it was a different crisis. So how would you explain this one?
I think we've got one more before you.
That's another.
Hi, my name is Oliver Grimm. I'm the DC correspondent for North Sea newspaper called Die Presse. Could you elaborate a bit about the role of Cyprus as an offshore financial hub for the Russian economy, and also the way that the recent Eurogroup settlement might impinge on that role of Cyprus as a source of gateway for Russian financial flows? I'd be interested in that.
I think actually, well, maybe we take one more because this is going to be our last round. Yeah. Go ahead.
Thank you, Bram Halster with the Department of State. And if I may throw two quick questions. One, I presume you brought a crystal ball with you from Moscow, and so I would ask that you fast forward 10 years and tell us what you foresee for the impact of Medvedev's innovation push, specifically Skolkovo and Moscow as an international financial center. What will be the long-term impact of those? And secondly, I believe there was a World Bank study that said roughly 40% of Russian GDP was linked to organized crime. And if you would say that's a high or low number and just touch on that.
Okay.
Let me start with the question about money. What do most Russians do? They use cash. Cash. I mean, my mother-in-law is a typical example. She doesn't have a bank account. She doesn't trust banks. She uses cash. They use cash. So yeah, she's smart. So yeah, they've even with cash they've had a history of, even in recent times, as late as during the Gorbachev period, monetary confiscations, where they substituted, they got rid of the large bills because they thought that was being used for the black economy, so they got rid of everything above the 100 ruble note in Soviet times. What was that, 1990?
50.
Above the 50.
Above 50 back.
Okay. And some people say that that led to the putsch against Gorbachev because they were outrageous. So people trust cash, and you can still do a lot of things with cash. Nobody's talking about putting limits as they are here with using $100 bill notes because of fraud or in Europe. You said what explains the health of the Russian economy? Well, I guess I would go back, but maybe I've been living there too long. I'm not sure I really see it as healthy. I just see that compared to other emerging markets, it's not doing so badly. But of course, those of us who live in Moscow tend to think of the glass as half empty rather than half full. That it could be doing so much better if state assets weren't being stolen and so much corruption, etc. But that being said, the health of the economy comes from the fact that there are there's a lot of human capital, well-educated people who are going into these new service areas, and it's thriving for them because they're not having to reinvent the wheel, as in many emerging economies. They are basically finding ideas that have already been developed in the advanced economies and bringing them home and putting them into practice. So they're tremendously productive, small-scale investments that can be done. The problem is it's still very throttled relative to what it could be, because people are very concerned about bureaucratic interference and arbitrary administrative controls, etc. Particularly if you make an investment in a business that's successful. So, you know, stories are legion of business people who are complaining about that kind of interference. But I have to also say that those stories make good press, but the obvious health of the system, as seen in the statistics, is the fact that despite that difficult business environment, things still get done. You know, you go to small restaurants, they are thriving. You go to cafes, they're full. Their museums are operating, galleries are working, transportation, deliveries. You know, you order a pizza, it's there in 40 minutes. My 15-year-old son is very happy. Yeah, I mean, so it's things do work relatively well. Anyway, so I'll just leave it at that. In terms of your points, Andre, thank you for I'll correct the production number. And I think that when
Sales.
Is it, oh, the sales. Okay. Well, correct. I'll rebase that. And I think when I rebase that, you'll see that the 2006 number goes up as well. In terms of the dip in 2008, you know, when I looked at that, but you're right to raise that. I thought originally, of course, of the war with Georgia, but the war in Georgia came too late. That was August.
We can claim that the second dip started because of Georgia, and after that has been aggravated by the U.S. crisis. But it cannot be explained by the
from the
first
January, right, which was the period leading up to Medvedev's election. Right?
January 2008.
Right. I don't really have any ready explanation for that, but worth it. Okay. On Cyprus, what can I say? That in here, I guess I'm going to be speaking more as an old IMF policymaker than from the Russian perspective. Although I think that in this particular case, the Russian perspective is very much the same as the traditional IMF view, which is what was finally adopted on Sunday, which is what they should have done a week ago Saturday night, which is that when you have a bank which is insolvent, you deal with the bank which is insolvent, and the creditors of that bank take the hit, rather than spreading the pain throughout the entire economy on all depositors. It was a colossal mistake. I think that everyone recognizes it. And my understanding, talking to former colleagues at the IMF, including the Russian executive director, is that that was what the IMF and the Russians expected to happen going into a week ago Saturday night, but that the Germans basically gave the benefit of the doubt to the Cypriots, who really wanted to preserve their business model at all costs, because the country derives its growth from two things: tourism and offshore banking, and they're basically the same client group: Eastern Europe, mostly Russia, and the Middle East, and that they felt that if Laiki Bank or Bank of Cyprus went down the drain, that they would lose. That would be the end of their economic model in their future. And so maybe it was a misreading of the situation by Michael Cyrus, the finance minister, of what would affect more adversely the business model for those two big banks to take a hit, or to have all banks in Cyprus, including the 50% of the banking sector, which is dominated by foreign branches, to take a hit. And apparently the president made a plea, and the European Union and very reluctantly the IMF kind of initially went along with it, but everybody has backed off, and now they're at a solution which it's going to hurt, but at least it makes sense. The problem is that the damage has already been done. If I were a Russian investor or any foreign investor, I certainly would not want to put money in a Cypriot bank at this stage. And it will be interesting to see how these capital controls that are supposed to be going into effect in a currency zone can be consistent with the whole notion of a common currency. I think it's a muddle that is destined to come unstuck. I just don't know how and when, and what the consequences will be, because I just think that enormous damage has been done in the process. And I certainly think that, I suspect that probably the newspapers are correct, that the serious Russian money, the really big money, has probably left in the last few weeks anyway. And that as very often, as we saw with the too big to fail banks or the US markets, that the people who get left holding the stick are usually the smaller and medium-sized investors who were not so well informed or so agile. So it will take a long time for Cyprus to reestablish its credibility, and I think that this will be like a slowly, instead of a balloon popping, it will be a slowly deflating one for the Cypriot economy. And I think as the economy deflates, it will probably require more assistance over time. Maybe on the last questions, it's hard to think 10 years forward. I try to do that for my university, the Higher School of Economics, where we're also trying to project what's going to happen to higher education in Russia years hence.
Or 5 years back, since you started the innovation push in 2008.
Right.
To date.
But I'm optimistically skeptical. That is to say, I think that the Medvedev's reforms go in the right direction. I'm not a great fan of the Skolkovo project. I think it's like many things of its kind. It's a bit artificial, but sometimes, as some would say, it's better to start with something, even if it sounds hopelessly optimistic, and try to build on it to create some momentum over time. And so it's probably a good idea. It's it's cost ineffective though. It's a lot of money being put into something for relatively marginal gain. I think there are better ways of trying to build up existing, schools of management, etc. But fortunately, Russia has the money right now, so it's maybe wasteful, but it's still, I think, has potential. Moscow is an international financial center. I've always said when I've been in these meetings in Moscow, organized by Voloshin and others, trying to organize this concept, I've always said it's rather ironic that you're trying to organize Moscow as an international financial center before you've convinced Russians, going back to my point about money demand for rubles, before you've convinced Russians to actually save their money in rubles and do their own operations domestically in rubles. So I said maybe you should try to figure out first how to get Russians to save their money in rubles onshore and trust Russian financial institutions. Now maybe what happened in Cyprus will maybe be a turning point for Russia as an international financial center. And I'm not entirely joking about that. It may make some Russian investors see the light. But I think the counter argument to my skepticism is that even if Moscow never becomes an international financial center, by pushing this agenda, you're trying to bring all the right kinds of things into existence. A better Moscow in ecological environment, better traffic, better schools, better airport and customs clearance facilities, rule of law, custodian operations, so that all of these things, even if it never comes to full fruition, are good in and of themselves. So it's the right path to pursue. Whether it, as I say, it actually happens or not. So I think that the Medvedev reform ideas are sound reforms. They make sense. I think that they will be more or less pursued as time goes on, because I think that there's really nothing else. I mean, I don't think Sergei Glasyev's agenda is going to go forward very far. You know, wrapping yourself with a national flag and patriotic themes maybe sell well, but it's not really an economic agenda, and so I don't think there's anything else out there that anyone else has in mind.
Well, on that note, thank you very much, Martin, for a very interesting presentation and answers to a wide range of questions today. And thank you all for coming. And we hope to see you here back at the IISS-US soon. Thanks again.